If you had a dashboard that flagged the most volatile weeks of the year before they hit, would you change your positioning? Do you think we get a 5 to 8% S&P pullback first? Comment buy if you're staying long or hedge if you're taking risk down. I'm Rebecca Kurzweil. This is Midday Bell. My guest today is Silas Peters, founder and head trader at T2 Markets. He built Trend Insider, software that blends seasonality, technicals, and institutional positioning into COT hedge fund flows to stack probabilities. Today, we'll show you why September into October is historically the weakest stretch of the year, why VIX typically rises into October, and why pros are positioning, adding bond exposure and using options to SPX, SPY, to the SPY, and VIX to express views. If you've ever wanted a right-hand side of the chart roadmap, this is it. Silas, it's so great to have you today. I would love it if you could just give our audience a little brief introduction into who you are, what your history is, and then we absolutely want to hear what your insight is into the market and what stocks you're watching right now.
Yeah, thanks for having me on, Rebecca. I really appreciate it, and thanks for having me on the show. So my name is Silas Peters. I'm the founder and head trader of T2 Markets. I also run T2 Trade Lab and T2 Market Research, and also am a partner, co-founder, advisor in Blue Marlin Advisors. I got my start in the markets right out of college, working at the Chicago Board of Trade, working for a large hedge fund desk, trading really anything from corn, soybeans, and cattle to the Japanese yen to S&P, and then went on and worked to manage some equity and fixed income portfolios for a bank, been a part of investment consultant for a billion-dollar family office, and part of multiple trading firms and brokerages, and now have the pleasure of running the financial publishing business and being an advisor in the markets to our clients and students.
Amazing. Okay, so yeah, I love that. A lot of experience, and I'm dying to know, as any investor wants to know, like, what is catching your attention and what are you focusing on right now?
Yeah, so I think the big thing to focus on is where we are in terms of the calendar year, and noting that the valuations in the market are high. It's not about trying to call tops or be a perma bear or say we got to put cash under the mattress. It's just being cognizant of the risk reward skew where we are, considering the 25% plus we're off from Liberation Day lows, and knowing that we are very likely at a time of year from a historical perspective or just plain cycle perspective that September is a very notable month on the calendar. This is not something that's just speculation on my part that I think the market is high or overvalued or overpriced. It's not that. It's that knowing that what has happened in history does likely tend to happen in the past. History does like to repeat itself. And this is total, any type of volatility. And we started to see that over the last couple of days. This volatility weakness that runs through the end of the third quarter is the weakest period of the year. And that alone, considering that prices also align with time, it denies us from being super aggressive in risk assets at this time of year.
Yeah, so Q4, we're entering obviously the end of the year, Q4. This is typically, I mean, the same pattern happens every single year. So what is that pattern? Things typically go down in Q4?
Well, so it doesn't happen every single year. It's just what we work with are odds and statistics to put the odds in our favor. So what we do is we have software that we've created that I can share with you at some point with the audience here, is that we have data of multi-year average, culmination of multi-year averages, where it's not about trading with 1 year of data or 2 years of data. We're talking 5, 10, 15, 20 years. And we have data going back 50, 60 years on certain equities. And we are looking for high probability areas of influence where prices have typically cycle top or cycle load. And we trade those kind of peaks and troughs respectively if all things else are aligned.
Okay. So you have a chart that we can share, and I'd love to get into, what these typical patterns are and these peaks and valleys are that you're speaking about.
Sure.
Okay, I'm going to share. Amazing. Okay. So yeah, what are we looking at right now?
Yeah, so we're looking at a piece of software that we developed called Trend Insider, and it's more than just seasonality software, but seasonality is one of the larger components. But it's also important to note that seasonality is just a tool. It's not a, buy here, sell here, just like anything, any prudent investor or trader, I hope would understand. But we're trading in lines with odds and probabilities. And so we can clearly see that as we get into, and actually I'll turn on 2025, for the most part, we follow it in line with data going back to 1993. So you can see that we've got 10 years of data in blue, we've got 20 years of data in yellow, and we've got 30 some odd years in red. And this is what we're looking at on these patterns. And again, yes, we're looking at the SPY or the S&P 500. We could be looking at the Canadian dollar, or we could be looking at live cattle. We have these same patterns that present themselves over and over again. And so what we try to do is we say, okay, we know where these high probability turning points are in a market. Now, where are we in current time, as in like, where are we today? Is price lining up, which we are, and we can clearly see the right-hand side of the chart. That's the $64,000 question that every trader investor wants to know. What's the right-hand side of the chart? Well, seasonality in this data gives us that. We can clearly see that what's the path of least resistance that we typically head lower. Does it happen every year? No, we have other nuances. We might, and this year we might have, no Chinese tariffs. We might have any type of headline skew what has happened in the past, but it is what we're trying to do is align with what has happened in the past on average.
Is this the Dow that we're looking at? Sorry, or like what?
This is the S&P 500.
S&P 500. Okay.
So we have the S&P 500.
Wow. So it typically just trades, and each line that we're looking at is years.
Yeah. So it's a culmination of years. So what we can do is this data right here gives us the complete history of the SPY going back to this is 20 years of data going back to 05 to 25. Yeah. And then here's 10 years. And then here's all years of data. And so what we notice here with this basket of averages is that we don't have one going here or one going here. They're all pretty much in tandem. And people will say, well, what about 2008? Or what about this year or that year when we have one year going off the reservation? That will happen, but it's about taking the basket of averages.
That's incredible. So typically the S&P 500, which represents kind of, obviously the stock market somewhat in general, I guess from a large cap perspective, like basically trades the same throughout the year.
That's true. And what it does is it lays us out. January 1st, we can be sitting on our couch and we have a projection for the rest of the year of the expectations. It doesn't mean that we go blindly buy or sell. We also start implementing other data, and we know, what is ahead. We can clearly see that we kind of peak out in July and then we head lower and we find a bottom in September. Monthly average performance right here. If our histogram is below 0%, we certainly don't want to be long, or at least if we're long now and the market is still rising, we might want to tighten up our stops, tighten up our risk. And then those that are knowledgeable and are active, then they could flip to look to short the market as well.
Wow. I'm actually just like blown away by how simple this information seems, but how most people probably wouldn't understand this or even know this. And so how would you be like trading? Like what is a trade to you? What is the length of that? And how are you using this information if you're trading the S&P 500 to get in and out?
Yeah, so this particular piece of software is not for day trading. It's giving us a larger lens or viewpoint of the market. And again, it covers 4,000 instruments, so you can plug in any stocks and asset classes you want. But for this episode and really where I start with my students each week is like we start with the S&P 500 because that is the global market. That is where the institutions are. And it's the most important market in the world. It's the driver. But knowing if we didn't know any other data other than seasonality, this data right here, I think we can all follow colors and we can follow ups and downs and we can see that, hey, this is where the market has typically gotten tired or become weak in August, September, and into the mid part of October, where we would then look to be buyers, because this right here starts the best next 6 months of the year.
Right.
But knowing this alone, and knowing that the S&P 500 right now, we have above average positioning I mean hedge funds and CTAs. I know that the historical pattern right now, we typically see a 5 to 8% pullback around this period. All of that right now, it has me very cautious of being long, and it's about not having FOMO, because the market does continue to notch up seemingly every day.
Yeah.
It's about being cautious and cognizant of where you are in terms of time.
That's really so. Can you explain to me too why? So we're looking at the biggest dips are happening when, in like March and October, or where?
So March and April is when we typically find a seasonal low. You know what happened this year, April, when we had the tariff or the Liberation Day, the market got hammered more than usual, but it did find a low in April, and that's happened time and time again. And then again, the expectations, just using probabilities and statistics, have us thinking that we probably should, or the path of least resistance at this time is to head lower, and then we would be looking to be buying the dip or looking for buys around mid-October.
And is this so? If it, regardless of like the tariffs happening this year, there's a pattern of these things happening in, say, March, April, regardless. And so why is that? That's related to like an earnings season. Is it always?
There's a lot behind the scenes, but earnings plays a factor. We have presidential election cycles have factors. Tax season has a factor in all this. And if you think about it, it's not just the S&P 500. This happens for individual stocks. It's probably even more prevalent, at least in my opinion, probably in commodities. That's where I got my start, Chicago Board of Trade, and where I had a real interest in seasonality, because things are being planted, harvested, grown, physically mined, and very dependent on the weather in various parts of the world. And so they're very cyclical and seasonal in nature. And so I notice these patterns happen time and time again. And if I know that we have what is a cycle high based on seasonality this time of year, I should know that the odds of buying ABC or XYZ market is probably not very good odds, or trying to sell right here when the market has gotten hammered, market is sold off. People are now selling because they're now trading breakouts and momentum, or they think the sky has fallen, knowing that this is really the time when we should be looking to buy,
Yeah. So this is the S&P 500. Are you like, is this your main stock that you're watching? Are you seeing these patterns across like other index related stocks?
Yeah, absolutely. So a lot of people, so we use kind of S&P 500 as a starting point, kind of a higher level. And then based on what we know about expectations of the S&P 500, then we can start going down into sectors. Then we can start going down in individual stocks and start getting more granular and thematic with that. But I still like to keep focus on the largest markets in the world, S&P 500 being one of them, but then also through the bond market. The bond market is the largest in the world, and we've been positioned in the 30-year bonds. We've been positioned in fixed income through 30-year bonds and 10-year note futures with these expectations. If I turn 2025 on, this is where we got long. Why would we be getting long right here? Well, we can clearly see we have a defined cycle low. I think I could show, my 5-year-old daughter that. She would probably say, yeah, that's a bottom, and it goes higher. So that's where we want to be long. If we're long, the question becomes, well, where do we want to start taking profits? Where do we want to start tightening our stops? It's probably right here, right? We see the top fizzle out, and then we go lower. And so the bond market, we're starting to see smart money and have been moving into the fixed income market, which we know it can serve as a safe haven in times of volatility or mean reversion or market turbulence. And we got a little bit of a taste of that over the last couple of days, not anything completely to write home about, but we would expect volatility to pick up. And that leads me to the VIX, which is the volatility index right here.
Yeah.
Clearly see that the VIX ticks higher into October. This is completely inverse to the S&P 500. So we are, I think one of the questions you asked that I didn't quite answer is, what specific sector or theme has my attention right now?
Yeah.
It goes without saying the S&P 500 is one of them. And we have started adding short exposure using options on SPX, SPY, S&P futures. And then we're also going to start expressing our opinion of a mean reversion type move using VIX and VIX options.
Wow. I love how geniusly simple this is. I mean, so your entire investing and trading strategy is just following seasonal patterns and using that as a guideline based on these kind of like major and index related stocks like the Dow, S&P 500, the volatility index. Yeah.
So it's a starting point, right? So like having this data is a tool. Yeah. And then what I call, it's not really about having a secret indicator or chart pattern that drives my decision making, but it's really what I call my three-prong approach. And that's seasonals, technicals, and instead of using the word fundamentals, I call institutional involvement. And that means basically, do we see institutional capital participating in that move? And we have software that we've created that reflects that as too. So I don't know if you're familiar with the Commitment of Traders report that's issued each week by the CFTC, but these are reportable positions by hedge funds. And so if we can track, because by law, they have to report their positions, we can track and follow those footprints. And what we see here, again, going back to the S&P 500, is they are heavy net short, or net short 175,000 contracts, and they've been building that net short. Just over last week's data, they added another 16,000 contract change, and it shows that, it's pretty interesting that here we are getting into September, notorious for the volatility and weakness. Funds have been shorting, and we also have price starting to kind of taper off and get tired at current levels.
Okay. The legacy reports, and this is part of the software that you created?
Yes, this is another piece of software, a dashboard that we created that tracks the institutional positioning side of things. So again, if we can combine seasonality, which we know, which is what we discussed, we can combine what hedge funds, or what we call smart money, is doing. Okay, that's two out of our three-pronged approach. And then very simply, we say, okay, we pull up a chart and we want to confirm that with technicals. Well, we can see that the market is at an inflection point. Yes, we're at all-time highs, but the market is getting weak, and the path of least resistance, at least in our opinion, is to pull back.
And what is your sentiment, say, on the S&P 500 in general? I mean, I think I've had a lot of conversations with people just thinking like that the trend will change, that like, S&P 500 has historically just been on a tear, and it's just gone up every year, without a shadow of a doubt, and it's been so successful. But that some people think that the sentiment may be changing now into more like resource related or more like economic, country building stocks. What do you see happening to the S&P 500? Do you see it, continuing to have this strong stride going forward, or having a major pullback in the investor sentiment switching to a different sector?
Yeah, I mean, it's a fair question, but in all honesty, it's a question I don't really know how to answer, because I found out that me trying to predict what I think is going to happen based off of some type of fundamentals usually doesn't mean, doesn't mean what. So what I do is I follow price action, and I let price action dictate where I should be entering and exit, and that gives me the best risk reward. So yes, we pay attention to some of the outliers out there from a global macro perspective. From a trading perspective, I'm not in the business of saying, hey, the S&P is going to end at 6,900 this year, or or I'm calling for 5,200 on the S&P. Nobody knows.
Nobody knows.
I'll watch, and you look at the brightest brains on Wall Street, whether it's from Goldman Sachs or BlackRock. Goldman Sachs might be saying 6,800. BlackRock might be saying 5,100. Who's right?
Who's right? Nobody. Fair enough. The game of predicting is probably somewhat of a losing battle in any case, really. I mean, it was 50-50, I guess.
Yeah, right.
Roulette, more or less. I mean, I love learning about this, about your strategy and methodology when it comes to investing. And it seems, because everyone has to develop their own strategy, essentially what they're comfortable with, and everyone develops a different one. And so what we're looking at, so tell me a little bit more about what T2 Markets is. And so if I'm like, say we met at a dinner party and I'm like, oh, what do you do? And you were to be like, and you were to give me your like quick, you know what I think, without giving investment advice, obviously, like this is what I do. And, if I was wanting to get involved, this is kind of, how I could become a part of it.
Yeah, well, it depends on how late we are at the dinner party on what I might say. But so basically, we develop software, we develop indicators, we develop education. I like to say I'm primarily I'm a price action trader, and so I don't try and predict. I let price action dictate my next move, and then we use tools like I've shown you here with using COT data, commitment trader data, seasonality, other fundamental data that we can incorporate. But then ultimately the technicals are going to be the driving factor of me putting on a position. Okay. So if I've got seasonality, I've got hedge fund institutional data lining up, and that also confirms with price, then it's like, let's go. We know our risk. We know our reward, which in that scenario, the reward versus risk is always favorable, which is the way we can afford to participate in the markets. But it's quite simple. It looks like a lot of data, a lot of numbers, and this and that. But all in all, it's just taking all these little pieces of information, and we're constantly trying to stack the odds and put the probabilities in our favor.
And are you also telling like your people that sign up on your website or join your team to like, this is now my biasing, like I'm making this trade now?
Yeah, so we have different services, obviously different software pieces, and do share those ideas to our students. Hey, here's the general thoughts, and here's the general analysis, or hey, I'm looking to get into XYZ and how I'm also structuring that trade. It might just be an outright, buying the stock or trading the underlying derivative, depending on what it is, or oftentimes it will be through the use of options. Could be through a debit or credit type trade.
Very interesting. Well, I've taken up 22 minutes of your time. Do you have any other like final words or anything we haven't covered today that you would love to share with just new investors, seasoned investors that would be watching this interview?
Yeah, I mean, I think the most important thing is to just always manage your risk. It doesn't matter what type of market environment we're in. Not over trading, not trading with money that you can't afford to lose. And then most importantly, just being patient. No FOMO is allowed. You've got to let price come to you. Being out of the market and being on the sidelines is certainly fine, certainly a position. Yeah. But don't get caught up in all the noise and the talking heads and afraid you're missing out from what you may have told me at a cocktail party. Yeah. It's mostly going to be BS, but focus on the data and focused on what's in front of you. And that's price. Price will usually lead the horse to water.
Yeah. Buy low, sell high.
That's it. That's simple, right?
Yeah. But everyone wants to buy high and sell low. So yeah. Anyways, I appreciate meeting you. It's been so fantastic learning about this. It's definitely opened my eyes to completely seeing the market absolutely differently. And yeah, I really appreciate your time. And I can't wait to talk to you again.
All right. Thanks so much for having me on. I've enjoyed it. Have a good day.
You too. All right, your playbook in one line. Respect the seasonal weak spot into late Q3. Watch VIX into October and let price, not FOMO, drive entries. From Silas, use a three-prong filter. Seasonals, technicals, institutional positioning, and size risk accordingly. Your turn. What's your move into September? Hold, hedge, or hunt for October buys? Drop in the comments so we can all learn from each other. If this helped, hit like, subscribe, and share. Big thanks to Silas Peters and T2 Markets for the Trend Insider walkthrough. I'm Rebecca Kurzweil. This is Midday Bell, and I'll see you in the next one.